Welcome back to another deep dive. I want to start by just welcoming you,
Right.
the learner.
Right.
Whether you're listening to this on your morning commute or at the gym, or maybe you're sitting at your desk right now just prepping for the market to open, we are really thrilled to have you with us today.
Absolutely.
Because today we are tackling a scenario that is, honestly, it's uniquely frustrating. I want you to picture this. You're sitting at your trading desk. You've put in the hours.
Yeah, that real grind.
Exactly. You've
Yeah.
mastered the technical side of your craft. You understand market structure. You know the charts inside and out. Like if someone mentions a Mandy D crossover, that momentum indicator showing the relationship between two moving averages, you know exactly how to trade it.
You've got it down cold.
Your strategy is back-tested. Your preparation is bulletproof. And then, well, the opening bell rings.
And everything just goes completely out the window.
Yeah. The heat of the moment hits, and you just watch yourself do the exact opposite of what your plan dictates. You're leaving money on the table.
Or you're moving a stop loss when your fundamental rule is to literally never touch it.
Right. You're forcing a mediocre trade just to feel some action because, I don't know, the market has been flat for 2 hours. And the worst part isn't even the lost money.
No, it's that immediate visceral regret.
Yes. You stare at the screen and you just ask yourself, why did I just do that? I know better.
We hear it all the time.
So we are dedicating this entire deep dive to answering that exact question. And the answer is, well, it's both simple and profoundly complex. The problem isn't your trading strategy. It's your mental game.
Right, it's the invisible ceiling for so many high performers. And I mean, not just in trading, but in literally any high-stakes environment.
For sure.
When people hit that wall of inexplicable errors, their first instinct is to look outward. They think they need another technical indicator, or maybe a faster charting tool.
Or they buy another seminar on global macroeconomics.
Exactly. But they are trying to solve a psychological problem with a technical solution. It's just a complete mismatch of tools. You can't fix a leaky psychological bucket by pouring more technical data into it.
Which brings us to the core mission of today's deep dive. We're unpacking an incredibly dense, fascinating stack of notes from Jared Tendler's work, The Mental Game of Trading.
It's such a brilliant framework.
It really is. Our objective today is to lay out a practical, step-by-step system for diagnosing and, more importantly, permanently resolving the emotional flaws that hijack your decision-making.
We're talking about diving into the big four: greed, fear, anger, and overconfidence.
Now, traditional trading advice, like the kind of stuff you read on day trading subreddits or hear from, self-proclaimed gurus on YouTube, it usually boils down to a single, really unhelpful phrase.
Oh yeah, control your emotions.
Right, control your emotions. And I look at that advice the exact same way I look at pulling a weed in a garden by just snapping off the top green leaves.
It looks clean for a day.
Exactly. The garden looks clean for a day, but the root system is completely intact underground. That weed is guaranteed to grow back. So today, we're digging up the roots.
And we have to, because the conventional wisdom of controlling your emotions is not just unhelpful, it's actively destructive.
Wait, really? Destructive?
Oh, absolutely.
Yeah.
It sets a trader up for a lifetime of unnecessary mental exhaustion. We really need a fundamental paradigm shift right here at the start.
Okay, lay it on us.
We have to stop viewing emotions as the enemy. Like there's some wild beast that needs to be caged or suppressed. Emotions are critical data points. They are internal signals.
They're actually trying to tell us something.
Exactly. When you feel a spike of fear or a wave of greed, your nervous system is trying to tell you something fundamental about a flaw in your underlying operating system. Fighting the emotion means you're literally ignoring the most valuable data you have.
I really want to spend some time on this idea of unlearning the old advice. Because the prevailing culture in finance, it often idolizes the ice-in-the-veins trader.
Oh, the total robot, yeah.
The person who feels absolutely nothing. There's this belief that emotions are inherently evil and they just must be boxed up and shoved into the darkest corner of your mind while you operate.
And the sources provide an analogy that I think perfectly dismantles that myth. Imagine you start getting these severe, blinding headaches at the end of every single trading day.
That sounds awful.
Right. Initially, you attribute it to the general stress of watching the market. So you employ some management strategies. You take ibuprofen. You download a meditation app and do deep breathing exercises.
Read like a walk around the block.
Yeah, exactly. You even cut your position sizes in half just to reduce the stress. And, well, those things actually work temporarily.
The headache subsides for the evening.
Right. But the next day, at 3 p.m., the blinding pain returns. Because you are aggressively treating the headache with painkillers, but you haven't bothered to check your eyesight.
Oh, I see where this is going.
It turns out your vision has naturally degraded over the years, and you are squinting at 6 different monitors for 8 hours a day. The eye strain is the root cause.
So the headache is just the symptom.
Exactly. If you go to an optometrist and get a proper prescription for glasses, the headaches vanish completely. The headache was never the disease. The headache was the alarm bell telling you that your eyes were failing.
That is so profound.
Right.
We treat our emotions like the headache. When a trader feels a surge of panic, they just reach for psychological painkillers.
Yep, they walk away from the screen, they practice box breathing.
Or worst of all, they exit a perfectly valid trade early just to lock in a tiny profit and alleviate that feeling of anxiety.
And those actions are just management strategies. You are literally just managing the symptom. Management requires active, conscious, mental energy.
It sounds exhausting.
It is. It's like putting training wheels on a bicycle so you don't fall over. I mean, there's nothing inherently wrong with training wheels when you are first learning, but you don't want to rely on them for your entire career.
What's the alternative then?
What Tendler's framework aims for is resolution. Resolving the emotion means identifying and fixing the root psychological flaw. Getting the prescription glasses, basically.
So that the emotional reaction never triggers in the first place.
Exactly. When you achieve resolution, you don't have to white-knuckle your desk to fight the urge to chase a bad trade. The urge simply ceases to exist.
To get to that state of resolution, though, we first have to honestly assess where we currently operate. The framework breaks our performance down into 3 distinct tiers, right? The A game, the B game, and the C game.
Yeah, and everyone listening is going to recognize themselves somewhere in this spectrum.
Oh, for sure. The A game is pretty obvious. It's your peak state, you're emotionally clear, your mind is sharp, and you're operating in a pure state of flow.
And what's interesting is that when you make a mistake in your A game, it's a pure learning mistake. You executed your plan perfectly based on the information you had.
But maybe the market just threw a genuine anomaly at you.
Right, or there was a nuance in the price action you just hadn't encountered before. A learning mistake is like a toddler falling down while figuring out how to walk.
It's not a failure of psychology.
No, it's an unavoidable requirement of physical and mental growth. You're just pushing the boundaries of your competence. But then, below that peak, you have the B game.
The messy middle.
Exactly. This is where most traders spend the vast majority of their time. Your tactical decision-making gets a little wobbly, but the defining characteristic of the B game is the internal tug-of-war.
So you feel the urge to do something stupid, but you can stop yourself.
Yes. The impulse to make a terrible decision is present-like. You feel the itch to revenge trade after a loss, but you still retain just enough presence of mind and executive function to resist it.
You fight the demon, and you win.
But it drains your energy. You hold the line, but it costs you.
Right. And then we descend into the C game. This is the dark place. The basement.
Oh yeah. The C game is a state of complete emotional chaos. At this level, your emotions are so intense that the logical centers of your brain literally malfunction.
So you're making those really obvious rudimentary mistakes.
Exactly. These are the errors you recognize as stupid the exact millisecond you click the mouse.
Ugh, I hate that feeling.
You force mediocre setups, you average down into losing positions, you increase your leverage out of pure rage. In the B game, you fight the urge. In the C game, the urge completely overpowers you.
You're just a passenger in your own body at that point. But, I hear this breakdown and a thought immediately jumps out at me.
Okay, what's that?
If the C game is caused by overwhelming emotion, and the B game requires all this exhausting energy to fight emotion, well, shouldn't our goal be to eliminate emotion entirely?
You mean be like an algorithm?
Yeah. Look at high-frequency trading.
Yeah.
The machines don't have a C game because they don't feel anger or fear. Shouldn't we strive to be as close to an emotionless robot as humanly possible?
And see, that is the trap. That assumes that zero emotion equates to perfect execution. But human neurobiology just doesn't work that way.
We are machines.
Exactly, we're not algorithms. If you strip a human being of all emotion, you don't get a perfect trader. You get someone who is apathetic, lethargic, and honestly incapable of making any decisions at all.
So emotion is actually necessary.
Emotion is the raw fuel of high performance. Consider Michael Jordan. His dominance wasn't born out of robotic, emotionless execution.
He was incredibly emotional on the court.
He used emotions, specifically anger, competitiveness, and perceived slights, as a massive source of energy. I mean, he was notorious for inventing reasons to be angry at an opposing player.
Right, because that anger sharpened his focus to a razor's edge.
Yeah.
He took things personally on purpose to elevate his biological state.
Exactly. Emotion is energy. The issue isn't that you have emotions. The issue is the volatility and the origin of those emotions.
I see. So when a novice trader gets angry, it's just explosive and erratic.
Right. It's uncontrollable and it destroys their strategy. But when a master gets angry, it's channeled, laser-focused fuel.
But to utilize that fuel, the underlying emotional waters have to be completely stable first.
And that is exactly what resolution provides. When you fix the underlying flaws, you don't become a numb robot. You become highly energized, incredibly focused, and deeply motivated.
You just lack the internal friction.
Precisely. Think about a time you resolved a bitter, year-long argument with a family member. When the air is finally cleared, you don't feel empty around them.
No, you feel relaxed. The tension just evaporates.
We want to bring that exact feeling of evaporated tension to your trading desk.
So before we move forward, I really want you, the listener, to do a quick mental audit. Identify what your specific C game looks like. What are your signature moves when you lose control?
That's a great exercise.
Are you jumping into highly volatile meme stocks just because you can't stand the thought of other people making money? Or are you dragging your stop losses wider and wider, praying for a reversal because you refuse to accept a minor loss?
You have to give your C game a name.
Right. You have to know what the target looks like before you can dismantle it.
And once you have identified those C game behaviors, you realize they're just symptoms of those internal signals overwhelming you. To stop the cycle, we have to become, well, forensic mental detective.
Forensic mental detectives, I love that. We need to map the internal pattern long before the explosive behavior occurs.
Exactly. And the source material uses a fantastic metaphor here to reframe how we view market triggers. It compares a trading meltdown to a bomb.
A bomb. Okay, break that down for us.
When a trader completely blows up their account, let's say they smash their keyboard, scream at the monitors, and double their position size on a terrible trade, they almost universally blame the market.
They'll say, oh, I got stopped out by one single tick, and then the market immediately reversed in my direction.
Right. They say, that specific unlucky tick made me furious. But that is a fundamental misreading of the situation. The market trigger, the bad tick, the unexpected news catalyst, the missed entry is just the detonator.
Okay, so what's the bomb?
The underlying psychological flaw sitting in your subconscious is the bomb. The detonator itself possesses zero explosive power. It just provides the spark.
Wow. So you brought the explosives to the desk. The market just lit the fuse.
Yes. To defuse that bomb, we have to separate the sequence of events into two distinct phases: the initial reflex and the secondary emotion. This is where the real detective work begins.
Okay, tell me about the initial reflex.
The initial reflex is your split-second biological reaction to a trigger. You take a loss, and before you even have a conscious thought, you feel a tiny spike of tension in your jaw or a hollow feeling in your stomach.
It is a pure physical sensation.
Exactly. The amygdala is firing. It is completely involuntary. But then, a fraction of a second later, your conscious mind gets involved. That is the secondary emotion.
So I feel the tension in my stomach,
Yeah.
and then my internal monologue kicks in.
Right. You start thinking, I can't believe I lost again. I am so stupid. I have to make that money back right now before the day ends.
And that specific conscious thought generates a massive secondary wave of emotion, usually intense anxiety, frustration, or rage.
Exactly. If the initial reflex is dropping a single lit match onto the ground, the secondary emotion is backing up a tanker truck and flooding the area with jet fuel.
And the tragedy is that traders spend all their energy fighting the jet fuel fire. They try to forcefully change their thoughts while they're already enraged.
They tell themselves, calm down, think positively, stick to the plan. But the neurochemical cascade has already happened. It's too late.
So to be a mental detective, you have to trace the inferno all the way back to the dropping of the match.
You have to map the precise sequence. Trigger, initial sensation, initial thought, secondary emotion.
But this detective work gets complicated, right? Because we rarely start the trading day with a completely clean slate. The notes introduce this concept called accumulated emotion.
It's a huge factor.
We all love the cliche of waking up, splashing water on our face, and saying, today's a new day, the past is in the past.
But our nervous systems do not operate on a 24-hour reset cycle.
They really don't.
The human brain possesses a natural digestion process for emotional events, much like digesting food. But if the emotional hit is too massive, or if the underlying psychological flaw is deeply entrenched, the brain just cannot process it all while you sleep.
So there's residual emotion left over.
Yes, it accumulates. Imagine you finish Tuesday feeling 15% more frustrated than your baseline. You don't do any mental work to resolve it, you just swallow it.
So you wake up on Wednesday already starting at a 15% emotional deficit.
Exactly. Your fuse is shorter. If Wednesday is a choppy, difficult trading session, you might wake up Thursday at a 45% deficit.
And now a minor market blip, like a delayed fill on an order that wouldn't normally bother you at all, hits that accumulated mass and causes a total C-game meltdown.
There's a detailed case study in the notes that perfectly illustrates the destructive power of accumulated emotion. It is the story of France, a Canadian academic.
Let's talk about France. He had built a stable 15-year career in academia, but he and his wife shared this massive dream of traveling the world.
So he decided to leave his secure job to trade full-time, specifically trading E-mini futures.
And for those who might not be familiar, E-mini futures are electronically traded contracts that track major indices like the S&P 500. They are highly leveraged, meaning a really small move in the market translates to a massive swing in your account balance.
It's a very fast-paced, high-pressure environment, and trading was supposed to be the financial vehicle that made his family's world travel dream a reality.
That's a lot of pressure.
France is a fascinating study because he wasn't reckless by nature. He was highly educated and analytical. Mathematically, to hit his financial targets and fund the travel dream, he only needed to execute one A-plus setup per day.
Just one high probability trade.
And on days when his mind was clear, he would wait patiently, spot the setup, execute it flawlessly, and log off.
But beneath the surface, there was a massive underlying flaw. The immense pressure he put on himself to be the provider.
The dream was heavy. Every single trade carried the weight of his family's future.
So let's track how this accumulated emotion destroyed him over the course of 3 days. Let's say it starts on a Tuesday. Friend sits at his desk. He's waiting for that one pristine A-plus setup.
But the market is erratic. Hours pass. Nothing aligns with his rules.
The mental strain of waiting starts to build, interacting with that underlying pressure to provide. He starts thinking, I need to make money today, or the dream gets delayed.
So he convinces himself to take a trade that is maybe a B- setup. He enters the market, and he takes a loss.
And immediately, the self-flagellation begins.
Oh yeah. France knows the math. He knows he violated his own rules. He spends the rest of Tuesday sitting at the desk, stewing in frustration, watching the market move, missing other minor opportunities because he is paralyzed by the morning's mistake.
He ends the day in the red, carrying a heavy dose of anger directed entirely at himself.
He shuts down the computer, spends the evening with his family, and tries to force a smile. He tells himself, shake it off, tomorrow is a fresh start.
But he hasn't processed the error. The emotion is swallowed whole.
So Wednesday morning arrives. France sits down, believing his emotional dial is set to 0. But he is actually starting the day at a 30% baseline of frustration left over from Tuesday.
Wow. Okay, so the opening bell rings. Almost immediately, he sees a setup forming. But it's slightly congested. It isn't the perfect A-plus setup.
Remembering Tuesday's pain, he hesitates. He holds back. Then he watches the price explode in the direction he anticipated, leaving him behind.
The urge to correct Tuesday's failure and make up for missing Wednesday's move hits him like a freight train.
The accumulated emotion demands action. He chases the price action, entering the trade far too late. The market naturally pulls back and he takes another loss.
Now the internal monologue turns vicious. You idiot. You knew that was a late entry.
He becomes desperate. He starts scanning every single tick on a 1-minute chart, hunting for any excuse to jump back in. His analytical framework completely degrades.
He takes another loss.
He erupts, takes 3 more highly leveraged, terrible trades in a blind rage, and finally closes the platform feeling completely demoralized.
The most tragic element of accumulated emotion is that it rarely stays contained to the trading monitors. It bleeds into your personal life.
Absolutely. The notes detail that the next morning, Thursday, France wakes up so tightly wound that a minor disagreement over the morning routine with his wife and son turns into a loud argument.
Because of the fight in the kitchen, he sits down at his trading desk 20 minutes late. He opens his charts and realizes that while he was arguing with his family, the market presented the exact pristine A-plus setup he had been waiting for all week.
And he missed it.
Oh man.
That realization is the detonator hitting a massive 3-day accumulation bomb. His executive function completely flatlines.
Without waiting for a candle to close, without consulting a single indicator, he clicks buy on a terrible position out of pure venomous spite and desperation.
The cycle of accumulated emotion completely dismantled a highly intelligent man's ability to execute a simple, proven mathematical edge. He blew up his week because he lacked the tools to see the emotional pattern building day by day.
This highlights why mapping your pattern is so critical. I like to think of it like having an internal GPS system while driving through a dense mountain fog.
That's a good way to look at it.
If you're driving blind in the fog, you have absolutely no idea a cliff is approaching until your front tires literally leave the pavement. It's too late to react.
Right.
But if you have a map GPS, it chimes a mile in advance, warning you, sharp turn ahead, reduce speed.
Exactly. When you map your triggers, when you learn to recognize that a sudden tightness in your chest or a tendency to lean 2 inches closer to the monitor is your first sign of impending sea game, you're giving yourself that GPS warning.
You can apply the brakes before you drive off the cliff of revenge trading.
The brilliant part of this process is that traders already possess the exact skill set required to do this. I mean, you spend your life analyzing charts, looking at moving averages, studying volume profiles.
You parse through endless market noise to find patterns, causality, and predictability.
Right. Becoming a mental detective just means pivoting that exact same analytical skill inward. You turn your forensic eye onto your own physiological and psychological signals. You are charting your own mind.
Practically speaking, if you are listening to this, you need a notebook next to your keyboard. You have to capture the data.
What is the trigger? What is the very first physical sensation? What is the initial thought?
What is the behavioral change? Do you suddenly snap at your partner when they text you? Do you find yourself checking your profit and loss column every 30 seconds instead of analyzing the chart structure?
Those are your leading indicators.
And once you begin documenting those leading indicators, you start to realize something profound about the nature of improvement. Which brings us to a major pivot in the Tendler system.
Yes, once the pattern is mapped, you have to fundamentally reconstruct how you view progress. True, sustainable improvement isn't just about pushing your peak performance higher.
It's about actively pulling your absolute worst performance up. This is one of my favorite concepts in the entire deep dive. The inchworm concept and the philosophy of sucking less. But before we get to the visual of the inchworm, we have to clear up some common learning pitfalls.
A lot of what traders diagnose as deep-seated psychological trauma is actually just a misunderstanding of how the human brain acquires new skills.
This is a massive revelation for many people. They convince themselves they have a fatal psychological flaw, like a deep fear of success or a subconscious desire to self-sabotage.
When in reality, they just don't understand the biology of learning. The classic example is the transition from a paper trading simulator to the live market with real capital.
Oh, this is the most common story in finance. A guy signs up for a simulator account with fake money. He turns 10,000 virtual dollars into $1 million in 3 months.
He feels like a sniper. He thinks he's the next legendary hedge fund manager.
Then he funds a live account with real money. He takes his first setup and he completely freezes. His palms sweat, he hesitates, he panics, and he exits early. He immediately assumes he has a psychological block regarding money.
But the reality is entirely biological. In a simulator, the outcome carries no real-world consequences. Your central nervous system knows it's playing a video game. It remains calm.
But when you put real capital on the line,
Capital that pays your mortgage, capital that represents your ego, your status, your safety, the environment fundamentally changes. It becomes high stakes.
and the brain has to react differently.
To operate in a high-stakes environment, your brain has to process a massively increased density of data. To facilitate that, your nervous system dials up. It releases norepinephrine and adrenaline.
You experience an elevated heart rate, a sense of tension, a heightened state of alertness.
These are biological requirements for transition. Your body is physically preparing you to absorb data in a dangerous environment.
So feeling amped up, feeling that pressure in your chest, isn't a sign that you are failing. It's a sign that your body is working correctly to help you learn.
Precisely. The problem arises from a flawed belief. The trader believes that nerves are bad and that they should feel just as relaxed trading real money as they did on the simulator.
And when they feel their heart rate elevate, they interpret their body's natural readiness as a threat.
That misinterpretation creates secondary anxiety. They become anxious about the fact that they are anxious. And it's that secondary anxiety that crushes their executive function. They didn't have a deep psychological block, they just had a fundamental misunderstanding of high-performance biology.
Normalizing that pressure changes everything. It allows you to track real progress through the learning curve. So let's introduce the inchworm concept. How does this visual model help us track improvement?
To visualize the inchworm, I want you to picture a standard bell curve on a graph. Imagine we could grade the quality of every single trading decision you made over the last year on a scale of 1 to 100.
Okay, I'm picturing it.
If we plotted all those decisions, they would form a bell curve. The large peak in the middle represents your average everyday B game. The thin tail extending to the far right is your absolute best peak A game.
And the thin tail extending to the far left is my disastrous, emotionally hijacked C game.
Exactly. That specific bell curve defines your current overall range of ability.
Right, so on my absolute worst day, I can only fall so far. And on my absolute best day, I can only reach so high.
Correct. You have an established ceiling and an established floor. If you're a veteran trader who has been in the markets for 10 years, your absolute worst C-game mistake today is still vastly more sophisticated than a mistake you made during your first month of trading.
Because I physically cannot make those day one rookie mistakes anymore.
Right, because that basic knowledge has moved from conscious effort to complete unconscious competence. You have developed a built-in biological stop-loss for poor decision-making.
So how does the inchworm move the bell curve?
Think about how an actual inchworm travels across a leaf. It stretches its body straight forward, anchoring its front feet. That stretching motion represents pushing your A game to a new peak.
You learn a new market correlation, you backtest a new entry trigger, you stretch your potential.
But the worm cannot just keep stretching its front half infinitely. It would snap. To actually move its mass forward, it has to anchor the front feet, lift up its back end, and pull its tail forward so its body bunches up in the middle.
Once the back end catches up, it can stretch forward again.
Exactly. The bell curve progresses through time by the front stretching out to a new high and the back catching up to establish a new low.
I see it perfectly.
The fatal mistake that almost every ambitious high performer makes is focusing exclusively on the front end of the worm. They are obsessed with learning more, pushing higher, finding the next sequel strategy, making larger returns.
They relentlessly stretch the front of the inchworm.
But they completely ignore the back end. They refuse to do the unglamorous, painful work of fixing their C game flaws. Because they never pull the back end forward, the inchworm gets stretched flat.
The bell curve widens dramatically.
And what does a wide bell curve look like in trading? Massive volatility. You experience incredible winning streaks where you feel like a genius, followed inevitably by catastrophic drawdowns where you give it all back.
Because your C game is literally an anchor pinned to the leaf. If you only stretch the front, eventually the tension becomes too great, and the back end violently yanks you all the way back to where you started.
Consistent compounding improvement is not about pushing your peak higher every day. It is about actively, intentionally pulling your bottom up.
You have to look at your C game and ask, how do I make my absolute worst trading day 10% less terrible?
When you eliminate your worst mistakes, the entire bell curve shifts to the right. Your old B game becomes your new C game floor. Your old A game becomes your new everyday B game.
And by pulling the back end forward, you naturally unlock the slack required to reach a completely new frontier for a higher A game.
The technical phrasing Tendler uses here is sucking less.
Which is such a liberating concept. You don't have to demand perfection from yourself every single session. You just have to suck slightly less today than you did yesterday.
The source notes provide a great case study about a trader named Brian who utilized this exact concept to turn his career around.
Brian's story is highly relatable because his issues weren't rooted in some dark, cinematic trauma. He was a futures trader who was chronically distracted by fantasies of wealth.
He spent his days visualizing himself trading from a laptop on a white sand beach in the Caribbean, living this glamorous, effortless island lifestyle. That fantasy was actually poisoning his reality.
He was so fixated on his imaginary A-game destination that he completely ignored his C-game reality.
Exactly. The fantasy demanded perfection. Because he wanted the perfect end state, if he woke up late and couldn't complete his flawless 45-minute pre-market routine, he would just skip the routine entirely.
All or nothing.
Right. If the morning market was slow, instead of analyzing the chop, he would walk away from the screens and browse the internet. When he did take a trade, he would oscillate wildly.
He would either take massive, greedy position sizes because he felt invincible, or he'd become hyper-fearful and only take picture-perfect setups.
Passing up dozens of solid singles and doubles, he was paralyzed by the massive gap between his actual skill level and his Caribbean fantasy.
So how did seeing the inchworm visual change his behavior?
It was an immediate paradigm shift for Brian. He realized he was trying to jump to the front of the inchworm without ever moving his back foot. The concept of sucking less completely dissolved the immense pressure of his perfectionism.
He realized that progress didn't require flawless execution today. It only required being 10% less bad than yesterday.
If he overslept and couldn't do his 45-minute routine, doing a focused 5-minute routine was sucking less than doing nothing at all.
It grants you the ultimate permission to be a work in progress.
By focusing his daily energy on simply pulling his C game forward, his consistency improved dramatically. He stopped agonizing over the profit and loss of individual trades and focused on the process of incremental upgrades.
His R factor, which is a crucial metric measuring risk to reward efficiency, essentially how much you risk to make a dollar, nearly doubled from 1.25 to 2.25.
He took more valid trades, managed them better, and actually started making real progress toward his financial goals because he stopped demanding perfection.
So practically speaking, how do we actually pull that back end forward? How do we fix the flaw? The notes introduce a mechanical tool borrowed from the high-stakes poker world called the mental hand history, or the MHH.
It's a 5-step problem-solving framework.
I think the best way to explain this is to role-play it. Let's walk through these 5 steps as if I just had a C-game meltdown.
Let's do it. The mental hand history works because it forces logical structure onto emotional chaos. Step 1 is straightforward. Describe the problem in detail. What exactly happened?
Okay, step 1. I was trading an index. I took a valid strategy-aligned loss in the morning, but instead of accepting it, I immediately jumped back in, doubled my position size on a random setup, and blew past my daily drawdown limit. I revenge traded.
Good. You have the behavior. Step 2 is where the real work begins, and it's the step people hate the most. Step 2 asks, why does it make sense that you reacted that way? What is the logic behind the problem?
See, this is where I usually get stuck. If I'm sitting there after losing a chunk of money and you ask me why it makes sense, my immediate internal response is defensive.
Of course.
I want to say, it doesn't make sense. I'm just an idiot. I know the rules and I broke them. Calling myself stupid feels like taking accountability.
But calling yourself stupid is actually a cop-out. It stops the analytical process dead in its tracks. The human brain, no matter how erratic the behavior seems, does not act without a reason.
It's doing something for a purpose.
In that split second of revenge trading, your brain executed what it believed was a logical protective maneuver based on a hidden bias or a flawed assumption. You had to extend yourself some grace and dig for that flawed logic. Dig deeper on your revenge trade. Why did your brain think doubling down was necessary?
Okay, if I really dig, maybe it makes sense that I revenge traded because deep down, I hold the belief that if I end the trading day in the red, I am failing my family.
Okay, go on.
I view myself as a provider, and a losing day feels like a direct threat to my identity as a good provider. So the urge to double down was a desperate attempt to protect my identity.
Excellent. That is a perfectly logical, albeit structurally flawed chain of thought. You found the hidden logic. Now, step 3, why is that logic flawed? You take the reason you just uncovered and dismantle it with facts.
The logic is flawed because one single negative trading day has absolutely zero statistical bearing on my long-term ability to provide for my family.
Exactly.
The math of my trading edge guarantees that I will lose roughly 40% of my trades. Believing that every single day must be profitable is a mathematical impossibility. A red day doesn't make me a bad provider, it makes me a statistical reality.
Step 4. What is the correction? You must articulate the new correct logic clearly and concisely.
The correction is, my edge dictates that losses are unavoidable. My job is to execute the edge flawlessly over a series of 100 trades, not to win every day. A loss is not a reflection of my worth, it is simply a business expense.
And finally, step 5. Why is the correction true? You anchor the new belief into your mind.
It is true, because every legendary trader in the history of the markets takes losses. Protecting capital and managing risk is infinitely more important to long-term survival than satisfying my daily ego.
That is the mental hand history in action. You took a chaotic, shameful, emotional outburst, isolated the hidden, flawed logic driving it, dismantled the logic, and installed a correct framework.
If you are listening, you need to apply this exact 5-step process to your own specific C-game errors. You must write it out.
Do not try to do this purely in your head, because as we will discuss shortly, your working memory is severely compromised under stress. Writing it down is non-negotiable.
Let's take this MHH framework and apply it to the specific emotions that plague financial markets. We will start with the one that is perhaps the most famous and certainly the most misunderstood: deconstructing greed.
Ah, greed.
Greed, for lack of a better word, is good. The immortal words of Gordon Gekko in the movie Wall Street. It's the defining quote of an entire financial era.
But this deep dive completely reconstructs how we should define and approach greed.
To do that, we have to look closely at the exact phrasing Gekko uses. He says, greed, for lack of a better word, is good.
Tendler argues that there is, in fact, a much better word. That word is ambition. We have conflated ambition and greed, and untangling them is vital.
Let's break down the difference. What separates ambition from greed?
Ambition is a healthy, potent, competitive drive to win. It is the desire to achieve greatness, to maximize your potential, to secure financial freedom. We applaud Olympic athletes for their relentless ambition.
Crucially, ambition understands the concept of risk.
It acknowledges that to achieve a goal, you must take calculated, well-managed risks within a framework. Greed, on the other hand, is what happens when ambition becomes excessive and completely clouds your judgment.
Greed blinds you to risk.
Greed demands a massive return right now, without any regard for mathematical edge or market structure. Gordon Gekko's terminology was flawed. Ambition is the engine of high performance. Greed is a psychological flaw that will inevitably cause you to blow up your account.
I think of the ambitious trader like a thoroughbred racehorse bred for the Kentucky Derby. The horse is genetically designed to run incredibly fast.
Right.
Traditional trading psychology tells you to manage greed by putting a jockey on the horse who constantly yanks back on the reins. Whoa, slow down, take profits early, don't be greedy.
But a horse running 1.25 miles while fighting the jockey's pull isn't going to win the race. It is fighting its own nature, expending massive energy just dealing with the friction.
Resolving the underlying flaw allows you to take the jockey off. The horse runs completely free, at maximum speed, fueled by ambition, but it naturally stays within the bounds of the racetrack because it inherently understands the geometry of the race.
That is a brilliant visualization of resolution versus management. And here is the most paradigm-shifting truth about greed presented in the Tendler system. There are virtually no performance flaws that are unique to greed itself.
Wait, let me make sure I understand that. Are you saying greed isn't its own distinct psychological disease?
Exactly. Greed is almost always a mask. It's a secondary manifestation of something much deeper.
Yeah.
When you use the mental hand history to dig into the roots of what looks like greed, you almost always uncover a profound lack of confidence, underlying anger, an illusion of overconfidence, or deep-seated fear.
That is a wild concept. The notes provide 4 very distinct case studies that prove this out. Let's go through them, starting with Alex, because his story looks like classic textbook greed on the surface.
Alex was a 16-year market veteran from Germany. He was an algorithmic options trader. On paper, his problem was simple. He wanted more money.
He would execute a profitable trade, but instead of being satisfied, he would get incredibly frustrated that he didn't capture the absolute maximum profit possible.
He spent his time fantasizing about massive, life-changing P&L numbers. He was plagued by regret for exiting positions too early. It looked, smelled, and acted like greed.
But when they applied the MHH and asked why he was exiting early, the mask slipped.
The greed was actually a cover for a deep fear of being wrong. He was exiting his winning trades prematurely because he was terrified the market would reverse and prove his initial analysis incorrect.
He needed the immediate validation of a locked-in profit to soothe his fear.
The grand fantasies about making millions were just his ego's mechanism for coping with the fact that fear was dictating his execution.
That is a massive mind-bender.
Yeah.
The intense greed for maximum profit was just a psychological ghost of the profits he was leaving on the table because he was too terrified to let his winners run.
Exactly.
What about the second case study, Roger?
Roderick traded global CME products in Forex. His manifestation of greed was aggressively destructive. If he had an easy, profitable morning session, the money was never enough.
He would force trades in the afternoon, trying to squeeze every last dime out of the market.
If he started the day with a loss, he would become hyper-aggressive, sizing up and forcing trades to take more than the market was offering, desperately trying to recover. He assumed he just had a greedy, desperate need for cash to pay his bills.
But the MHH revealed that his greed was actually pure, unadulterated anger.
Yes.
Where was the anger directed? At the market.
No, it was directed entirely at himself, and it stemmed from an unrealistic illusion of perfectionism. In Roderick's mental framework, taking a loss meant he had made a mistake, and making a mistake was fundamentally unacceptable.
He expected himself to read the market's intentions perfectly every single time.
When the market inevitably handed him a normal probabilistic loss, it shattered his illusion of perfection. He would explode with internal anger, and that anger masked itself as hyper-aggressive, greedy revenge trading.
He wasn't actually trying to make money. He was angrily trying to force the market to validate his perfectionism.
This brings up a critical question for the listener to consider. When you feel a surge of what you label as greed, are you genuinely being ambitious, or are you just desperately trying to avoid the pain of looking stupid?
Let's examine Max, a forex trader from France. His story highlights this exact dynamic.
Max did incredible work mapping his pattern. He tracked his greed across 10 distinct levels of escalation. His level 1 early warning sign was subtle.
He would just log in slightly more often to check the P&L on a trade that was already running.
By the time he hit level 10, he was a wreck manually managing trades minute by minute, completely ignoring his longer time frame charts, and obsessed with securing an immediate return.
But the breakthrough occurred when they analyzed the root cause of why he needed the money with such desperate urgency.
It wasn't to buy luxury cars. His greed was fueled by a profound, hollow weakness in his own confidence. He had originally started trading to prove to a skeptical friend that he could succeed.
That deep, unresolved urgency to prove his worth, to validate his own self-esteem through his account balance, caused him to constantly force trades outside his strategy.
His greed was simply a desperate plea for external validation.
The final case study is Chris. Chris had this constant swing for the fences, home run mentality that looked like the ultimate manifestation of financial greed. But his root cause was essentially a decade-old psychological trauma.
Yes, Chris's story is fascinating. 10 years prior, before he transitioned to full-time trading, Chris held a position in a stock. He sold it to lock in a modest profit.
A month later, that company was acquired. The stock price went parabolic, and he missed out on genuinely life-changing money.
A full decade later, the pain of that missed opportunity was still the primary driver of his trading. His greed, his constant desire to hit a massive home run on every single trade, and his refusal to take normal profit targets was actually a profound fear of experiencing that specific, unique regret again.
He wasn't trading the reality of the current market. He was trading the ghost of a 10-year-old mistake.
So the takeaway here is that you have to rip the mask off. If you are struggling with what you think is greed, you must deploy the mental hand history and interrogate the emotion.
Ask yourself, am I actually angry that my analysis wasn't perfect? Am I terrified of looking incompetent to my peers? Am I trying to compensate for a massive mistake I made 5 years ago?
And very often when you pull that mask of greed away, what you find lurking underneath is pure, unadulterated fear.
Which transitions us perfectly into deconstructing the emotion that paralyzes more traders than any other. Fear, uncertainty, and FOMO.
Fear is the heavyweight champion of trading errors.
It makes you sweat, it spikes your heart rate, and it makes you close your laptop and walk away from perfectly valid, back-tested setups.
But the text makes a profound point. Before we can conquer fear, we have to define what fear actually is at a biological level.
At its core, fear is deeply rooted in uncertainty. When a human being possesses absolute certainty about an outcome, fear cannot exist.
The book uses a brilliant thought experiment to prove this, called the trading fairy.
I love this concept. Let's explore the trading fairy.
Imagine you are sitting at your desk, incredibly anxious before the market opens. You're in a 2-week drawdown, your confidence is shaken, and you are terrified of taking another loss today.
Okay.
But 5 minutes before the opening bell rings, a magical trading fairy appears on your shoulder. She possesses perfect knowledge of the future, and she tells you exactly what is going to happen today.
She says you are going to take 3 small consecutive losses in the first hour of trading. But at exactly 2:08 p.m., you will catch a massive, sustained trend that will make your day wildly profitable.
If you possess that absolute certainty, would you feel any fear while taking those first 3 losses?
Absolutely not. I would be sitting back, sipping my coffee, happily entering those losing trades because I know they are just stepping stones to the guaranteed 2.00 p.m. winner. The fear completely evaporates.
Exactly. The mathematical reality of the losses didn't change. You still lost money in the morning. The only variable that changed was your certainty.
Uncertainty is the breeding ground for fear.
It presents a question that your brain desperately wants answered, will I be okay, but cannot find the answer to.
Before we dive into the deep psychological flaws that cause fear, the Tendler system issues a massive warning. You must rule out technical flaws first.
Sometimes fear isn't a psychological defect, it is your brain accurately warning you that your trading plan is garbage.
This is a vital distinction. We see this in the story of Vishal, a trader from the UK. Vishal was suffering from crippling anxiety and hesitation at the exact moment of execution.
He would see a setup, his hand would hover over the mouse, and he would freeze. A million questions would flood his mind.
What if the higher time frame is bearish? What is the volume doing? Should I wait for the candle to close?
He diagnosed himself as having a deep psychological fear of failure. But when they mapped his pattern, they realized his fear was entirely rational and appropriate.
He was a discretionary trader, and his trading plan was incredibly vague. He had left far too many variables unanswered.
His brain was sounding an alarm bell, screaming, "Do not put real capital at risk right now. We haven't defined the parameter."
Precisely. The doubt and hesitation were accurate signals of a weak, incomplete strategy, not a weak mind.
Vishal fixed his fear not by doing deep psychological therapy, but by turning off his monitors, opening a spreadsheet, and doing the hard work to systematize his strategy.
He answered all those variables in his trading plan before the market ever opened. Once the technical uncertainty was removed, the emotional fear vanished instantly.
Let's assume your technical plan is airtight. Your backtesting is solid. Let's break down the 5 signs of fear that indicate a genuine mental game flaw.
Sign number 1 is risk aversion.
Risk aversion is a natural evolutionary protective mechanism. If someone throws a heavy punch at your face, your hands instinctively fly up to protect yourself. It keeps you alive.
But imagine a toddler throws a slow-motion punch at your shin. You don't flinch because there is no threat of genuine pain.
In trading, if you find yourself terrified of taking a perfectly valid risk within your system, you have to ask yourself, what abstract pain are you trying to protect yourself from?
Are you protecting a fragile ego? Are you protecting your status as the smart friend? Are you terrified of the embarrassment of having to admit you took another loss?
Sign number 2 is fascinating because it is deeply tied to neuroscience, and it happens to almost everyone. Overthinking.
Overthinking is directly linked to a specific biological limitation in our brains, known as working memory. Think of working memory as the mental whiteboard where your active, conscious thoughts happen.
Under normal, calm conditions, you can hold maybe 5 to 9 pieces of information on that whiteboard simultaneously. It's how you evaluate multiple variables at once.
5 to 9 pieces of information is already a pretty small whiteboard for a complex environment like trading.
It is. But when anxiety and fear spike, your body floods with cortisol. That cortisol physically impacts the prefrontal cortex, and that mental whiteboard shrinks dramatically.
Suddenly, you can only hold 2 or 3 pieces of information at a time.
Imagine trying to assemble a complex 1,000-piece puzzle, but you are only physically allowed to look at 3 pieces at any given time.
Your mind goes into frantic overdrive, spinning in rapid loops, desperately swapping pieces in and out of working memory, trying to solve the puzzle of the market.
That frantic, exhausting spinning is overthinking.
Sign number 3 is second guessing. This is when you enter a trade, and 3 seconds later, the internal torture begins.
Oh no, did I miss a support level? Should I scratch the trade? Was my entry too early? It is agonizing.
Second guessing is a specific manifestation of fear directed at a decision that has already been made.
It highlights a profound lack of trust in your own analytical process, usually driven by an excessive, perfectionist desire to avoid making a mistake. You are trying to unmake a decision to alleviate the tension.
Sign number 4, not trusting your gut.
Intuition, or gut instinct, that's a bad reputation in highly analytical fields, but true intuition is essentially rapid, highly evolved, unconscious pattern recognition.
Your brain is processing thousands of data points faster than your conscious mind can articulate.
But because you cannot logically, step-by-step explain why your gut is telling you to take a trade, it feels uncertain. And as we know, uncertainty breeds fear.
So under pressure, traders often abandon their highly evolved intuition and retreat to rigid, comfortable, but often inferior decision-making metrics.
Finally, sign number 5, negative future, or as I like to call it, being a terrible psychic.
This is the classic what-if spiral. What if this trade goes against me? What if I string together 10 losses?
What if I blow my account, have to quit trading, and go back to a miserable corporate job?
You aren't actually asking a question to find an answer. Your fear has already assumed the catastrophic negative outcome is a guaranteed absolute fact. You're prophesying your own doom.
And ironically, by flooding your nervous system with that fear, you guarantee you will make the exact C-game mistakes necessary to bring that doom into reality.
This analysis of fear brings us to the most ubiquitous acronym in modern trading. FOMO, fear of missing out, is the absolute plague of the retail trader.
You open Twitter, you see a stock rocketing up 200%, everyone is posting screenshots of their profits, and you just blindly buy the top because the pain of missing the party is unbearable.
FOMO is an incredibly powerful, socially driven force. But Tendler's framework identifies that there's only one specific psychological flaw that is completely unique to FOMO.
The delusion that there will never be another opportunity.
When FOMO hits, your brain hyper-focuses on the current moving asset. It creates a tunnel vision that completely deletes the objective reality that the market opens again tomorrow.
And the next day, and there will be tens of thousands of other opportunities over your career.
But much like greed, FOMO is often a mask for other underlying fears, right?
Yes. We see a brilliant example of this in the story of Carlos. Carlos was a full-time trader who had a major breakthrough using a simple mantra: don't hide, ask why.
Whenever Carlos felt the intense FOMO urge to jump into a trade early before his setup was confirmed, he forced himself to take his hands off the keyboard and ask why he was feeling that panic.
He realized he was trying to catch a razor-thin knife-edge pivot in the market using a 5-minute chart while employing a very tight stop-loss.
Wait, if he is using a tight stop-loss on a 5-minute chart, he physically cannot see the exact microstructure of the market turning. The data is too aggregated.
Exactly. His FOMO, the panic to get in early before he missed the move, was actually a highly rational fear that his charting time frame was too slow and clunky for his specific strategy. He was flying blind.
He fixed the issue by switching to a 30-second chart for his entries. Suddenly, he could see the exact tick-by-tick microstructure of the turn.
He didn't have to guess or anticipate blindly. The FOMO completely evaporated, not because he meditated, but because the technical uncertainty was removed.
Which proves again and again, you must interrogate the emotion. Okay, but we have to address the ultimate fear, the apex predator of trading psychology, the fear of losing.
Nobody likes losing money, but for some traders, it is a paralyzing, career-ending phobia.
To deconstruct the fear of losing, you have to ask yourself a brutally honest, uncomfortable question: what is actually on the line?
When you lose a trade, factually, you are losing a percentage of capital. But what does that money represent to your subconscious? Does it represent your ability to provide for your family?
Does it represent your status among your peers? Does it represent your escape from a job you hate?
If a $500 loss subconsciously translates to, I am a failure as a provider and I will be trapped in my cubicle forever, of course you're going to be terrified. You have attached your entire identity, ego, and future to a single probabilistic coin flip.
So how do we detach? How do we separate the mathematical reality of a loss from the deep psychological pain of a loss?
You have to fundamentally change your relationship with the pain. The book uses a powerful analogy that resonates with high performers. Imagine a professional marathon runner preparing for the Olympic trials.
They are training hard and they feel a sharp shooting pain in their foot. They're terrified.
They think it's a structural stress fracture that requires surgery and will end their Olympic dream. They go to a specialist and get an MRI.
The doctor reviews the scan and says you do have an inflamed tendon. It will need rest eventually, but running this race will not cause any structural damage. It will not end your career. You just have to endure the pain.
Wow. So the pain is still very much present, but the existential threat is gone.
Exactly. For highly ambitious, competitive people, losing a trade will always sting. It will always be somewhat painful.
But you have to rewire your brain to realize that the pain is not a threat to your survival or your identity. It is simply the unavoidable physical cost of doing business in a probabilistic environment. You have to learn to take the punch, acknowledge the sting, and keep moving forward.
Let's bring all of this together into practical application. What does this mean for you, the listener, when you're sitting there in the heat of the moment staring at a massive red candle? You are paralyzed by fear.
Your heart rate is 120 beats per minute, your cortisol is spiking, and your working memory has shrunk to the size of a postage stamp. What is the immediate triage? How do you stop the bleeding?
The immediate triage is to externalize the internal chaos. You must bypass the biological limitation of your shrunken working memory. And you do that by writing.
You keep a physical journal and pen right next to your keyboard. When you feel the fear spike and the overthinking loop begin, you stop clicking the mouse, you pick up the pen, and you write down exactly what you are feeling in the specific what-if scenario spinning in your head.
By writing it down on paper, you're taking those puzzle pieces out of your cramped mental whiteboard and putting them on a physical table where you can actually look at them objectively.
Yes, you can read your own frantic thoughts and realize, wow, I am catastrophizing. One single loss does not mean I'm going bankrupt.
Writing it down is the triage that stops the immediate hemorrhage. It slows down the C-game descent.
Then, after the trading session is over and your cortisol levels have dropped, you sit down and apply the 5-step mental hand history to perform the surgical work of resolving the root flaw.
This framework is incredibly robust. Let's recap the journey we have been on today. We started by dismantling the toxic myth that emotions are the enemy, reframing them as vital internal GPS signals, highlighting hidden flaws.
We learned how to map our C-game, observing the initial reflex before the secondary emotional bomb detonates.
We embraced the inchworm concept, realizing that sustainable progress isn't about demanding perfection, but about consistently sucking less and pulling our worst performances up.
We ripped the mask off greed, discovering it is almost always ambition poisoned by perfectionism, anger, or a need for validation.
And we stared down fear, identifying it as a product of uncertainty that shrinks our working memory, demanding that we externalize our thoughts to regain control.
And the true beauty of Tendler's framework is that its utility extends far beyond the borders of a trading desk.
Absolutely. Think about how this applies to your broader life. Whether you are prepping to deliver a massive boardroom presentation, negotiating a complex salary raise, or even putting yourself out there to learn a frustrating new hobby like golf or chess.
The intense pressure and anxiety you feel in those moments isn't a sign that you are weak or incapable. It is biological data.
If you map your emotional triggers in those environments and apply the mental hand history to your real-world anxieties, you can unlock peak performance in literally any arena. You find the flawed logic, you correct it, and you move forward.
It truly functions as a universal operating system for the human mind under pressure. But before we wrap up, I want to leave you, the listener, with a final lingering thought to mull over.
Okay, what is it?
We have spent this entire deep dive discussing how to resolve these emotional flaws based on your current interaction with the market. You map your current fear, you resolve your current greed.
Right.
But consider this reality. Markets are not static entities. They evolve constantly. Macroeconomic regimes change. Algorithmic dominance shifts. As you put in the work, master your current mental game and build this beautiful, resolved, emotionally stable architecture in your mind. How will your brain react when the entire market paradigm shifts underneath you?
Oh, that's a deep, unsettling thought.
Is it possible that the very psychological mechanism you just built to perfectly resolve today's fear might become so entrenched, so comfortable, that it is the exact framework that blinds you to tomorrow's real, tangible risks? Does achieving perfect emotional resolution create a psychological blind spot for the next black swan event?
That is definitely something to keep you up at night, and more pertinently, something to keep you sharp. The inchworm never stops moving. The work is never entirely done. Thank you for joining us on this exploration of the mental game. Take these tools, map your pattern, pull your C game forward, and keep diving deep.